Hey everybody, Frank Finance here. Hope you're having a wonderful day. It's getting towards the end of the year and it's a perfect opportunity to see if tax loss harvesting would be able to benefit you for the current tax year. In today's video, we're going to go over the definition, the benefits, some risk, and things you may want to watch out for, and then go over a few different scenarios to see and help you think through how you might be able to use tax loss harvesting in your individual situation. So jumping straight into the definition, tax loss harvesting is a strategy that can help investors minimize taxes they may owe on capital gains or their regular income. As a strategy, tax loss harvesting involves selling an investment that has a lost value, replacing it with a reasonably similar investment, and then using the investment sold as a loss to offset the realized gains. So basically, tax loss harvesting is taking realized losses and using them to offset realized gains during the current tax year. Now, it can additionally be used to offset ordinary income, but that's capped up to $3,000 for each tax year. Now, the benefits of this is it saves you money on your taxes. You take your marginal tax rate, multiply it by the amount of gains that you had, and that's your total. And then if you're able to offset dollar for dollar, that's how much money you'll save on taxes. The reason why this is important is its tax efficiency, being able to retain more money, and you can actually use that money to reinvest instead of have to sell assets, pay your taxes. Now on the risk side, you need to make sure that you're avoiding a wash sale if you're intending to use this money to offset any gains. Now a wash sale is when you let's say you sell a security and then you immediately buy back into the same security or something very, very similar to that security. It can trigger a wash sale. In order to avoid a wash sale, you got to wait 30 plus 1 days. So basically wait 31 days. You can rebuy the same investment or something similar, and you can take advantage of the losses to offset the gains. Now, selling an investment with more upside than the tax benefits would warrant is also a risk here. So you want to take what the investment is, understand the probability and upside potential, and weigh that against the tax benefits you would receive from realizing the losses to offset gains. Now, currently only taxable accounts can be used for tax loss harvesting, so basically brokerage accounts are really the only eligible account for that. IRAs, 401ks, 403bs are not eligible. They grow tax deferred. Even if you have a security that's trading at a loss right now, you cannot sell it and use tax loss harvesting. You're just, the only reason why you would want to sell that security is if you don't think it's going to continue to grow in the future or if there's a better opportunity. You cannot use this against taxes. Next, let's talk about some tax loss harvesting scenarios. We'll talk about long-term gains, short-term gains, realized loss, the taxes avoided, and the taxes due depending on the scenario. Now, in scenario one, you've realized 0 long-term gains, $10,000 worth of short-term gains. You've realized a $10,000 loss, and in this particular scenario, you pay $0 because you've offset your gains with the loss. The taxes avoided depend on your marginal federal bracket. And another thing to note here, these numbers do not take into account if you have a state tax. If you're in a state that charges a state tax, the taxes due / avoided are actually higher, so this benefits you actually more so. Now in scenario 2, 0 long-term gains again. Short-term gains are at $10,000. You have 0 realized losses, and so you've avoided $0 by not taking any losses. Now your taxes do depend, as I said, on your federal income bracket, marginal rate, and so whatever your highest marginal rate is typically what you would pay in taxes there. So 12%, 22, 24, 32, and that goes all the way up to 37% on top of if you're in a state that charges state tax. So these could be even higher. So in scenario 1 versus scenario 2, where we're realizing short-term gains, this is really the main benefit of being able to tax loss harvest, being able to avoid this dollar amount of taxes. In scenario 3 and 4, we're looking at long-term gains, and then we'll compare 3 and 4 versus 1 and 2. Now in scenario 3, long-term gains are at $10,000, realized loss of $10,000. Taxes avoided are smaller than what they are in scenario 1 and 2. Because the tax rate for long-term gains is actually much simpler. So it's 0%, 15%, or 20% depending on your income level. I'll go ahead and put up a little that right here for a moment. So basically in this one you have $0 due because you've offset those gains. In scenario 4, you have long-term gains of $10,000. You don't realize any losses. So you avoid zero taxes and you pay $1,500 or $2,000 depending on your income level. Now, when going through these scenarios, it's helpful to know what your marginal tax rate is, and it's also helpful to know what your long-term capital gains tax bracket is as well. Now, the reason why this is important is in certain scenarios, you can actually pay zero taxes on the long-term gain side if your income is low. But across the board, and generally speaking, it's much more advised if you're using tax loss harvesting to use the losses to offset short-term capital gains. And that is because long-term capital gains are taxed much more favorably than short-term gains. Short-term gains are taxed at ordinary income brackets, which are higher than long-term gains, period. So now for some highlights. Tax loss harvesting is basically utilizing realized losses to offset realized gains. It's important to know whether the gain is a long-term capital gains or a short-term capital gains, or if it's ordinary income. They have different benefit levels from a tax perspective. It's important to know your tax bracket. It's important to know your long-term capital gains rate. It's also important to know what investment you're selling and if you're going to miss the boat. It's also important to recognize whether or not you plan on buying back into it in a short amount of time, or if you can't wait the 31 days to avoid a wash sale. So I hope this video has been helpful on understanding how to use tax loss harvesting to be more tax efficient. Thank you so much for watching. I do videos on personal finance, investing, and stock analysis. My name is Frank Finance, out.